Anybody? Nobody's posted. I'll pass. Great. Okay. We're gonna review. Are you ready? You want to review? Perfect.
Here we go. Look at that. Thank you. Good afternoon. So we'll have the first quarter. Many of you know that are in the business. Not a pretty quarter for traditional assets, both fixed income as well as equities. What's that? You short? What are you shorting? But a couple places there was some positive news was in real estate. We do have a meaningful allocation to real estate, so that has been hugely helpful. So we'll skip the pleasantries up front, go to Exhibit 1. This is the report. So obviously we're going to focus on relative performance, how we did against our peers, and then obviously overall composites. In addition to this, we also have a fixed income search. Last time we kind of presented the idea of looking beyond principal for high yield. So we have some additional ideas that we first brought last time that include a mix of bank loans as well as high yield. So we'll get to that at the end. So let's jump to page 2. Next page should have market value. So at the end of March, I see 24,913,612. You see any cash flows during that time period, money in or money out. You see at the bottom, the private equity partners group was funded during the first quarter of the year. A couple pages ahead, page 5. Looking at the summary of cash flows. So first quarter, money out as well as net investment change was negative. Then you can obviously follow across the history there with net cash flows obviously be negative for benefits and net investment change positive over all of those various time periods. So get to the fun part. If you jump to page 8 and 9, performance. So January, the gravy train was over starting in January. That was down. February was down. March actually was a slight reprieve. I don't have April on here, but April was a catastrophe of sorts for equities. But you see for the month, fund was up 0.7 versus 0.6, but the first quarter fund was down -4.1 versus -4.3. And then that number beneath that, as a reminder, that's you against a grouping of public defined benefit plans with less than $50 million in assets. And that's not just Marquette. That's across a variety of providers through Investor Force. So 13th percentile, so better than 87% of the funds out there. So I said, everything is relative when things are off. So you can see obviously longer term performance for obviously beyond the good old days of 2021 and second half of 2020. Fixed income for the quarter protected a little bit, 5.4 versus 5.9. You're going to go down the list there. Principal core fixed income has not necessarily been the safe haven as it has been in prior equity market downturns. You have core plus a little bit behind that. High yield was down 4.0. And then you kind of look at high yield. This is the one we talked about last time. You look at the rankings longer term. They've been behind their benchmark as well as the rankings have not been great in their overall universe. And then preferreds, those are down 5 overall. And then compared to their benchmark, depending on what benchmark you look at, obviously both they're ahead of that. So that's good. US equities down 5.3 versus 5.3. So the mix of passive management was right in line with the Russell 3000. And one of the things that we've seen, obviously not specific to you guys, because we're all passive here, but clients that are kind of diehard active managers, really haven't seen a lot of protection with active management the first quarter. It was kind of surprising. But going down the list, you see the S&P 500 was down 4.6. Mid cap value was flat 0 versus 0.1. We've seen a little more dispersion, especially on international, you'll see, versus the benchmark, just due to the volatility, but in the long run, that'll all even out. And then growth, which got hurt a lot more with interest rates coming up. See, that was down 12.3. Small value was down 1.2, and then small growth was down 11.9. So pretty much no matter what cap size, value protected more than growth. So historically, not totally surprising in this environment. Upper of page 9, also down 6.3 versus that benchmark. International stock index was down 6.1. Benchmark was down 5.2, so a little off there. And then the FTSE All World small cap was down 7.4, and then emerging markets was down 6.3 versus 5.2. You know, most clients wanted to talk a little bit about Russia first quarter and kind of the weighting there. This particular index, there was about 1% in the overall. When you look at all of your allocations there, about 1% of your non-US was in Russia, and Russia, as we sit here today, all those have been written off there. And then the bright spot is real estate. You see that was up 7.2 versus the benchmark, which was 7.2. You're trailing 1 year of 28.2 versus 27.3. So you've seen real estate really go gangbusters. At some point, that will end, of course, as all things do, but that has been tremendously helpful having that. And you're a little bit overweight. I think you're a little over 11% versus 10% there. Partners Group was funded in January, so we don't have the most recent numbers there, but they did pop a slightly positive number in January, just because this isn't going to be as subject to the swings and the whims of the public equity markets. So that's good. We got a 5% allocation there. Your history is page 10. We'll jump to the back of this tab here. Let's go to page 29 for fees. Actually, as long as we're right, page 28, just say a 30 seconds on principal real estate, since they've done so well, kind of what has been working. They've really been in the right spots. You know, you follow demographics, anything south or west, that's where people are going. They've been overweight there. That helps. That's been a big driver of real estate. And then within the various food groups, they've been underweight office, underweight retail, overweight apartment, and then their main overweight has been industrial, which has been, you know, light years ahead of everything else. So they've been in the right spots, no matter how you look at it. Page 29 is fees. So as always, just look at the fees. See 40 basis points in blue for the various investments, which is about, looks like just under $100,000 annually. That is asset based. So as investments go up and down in value, so does your total dollar amount. And then the industry median is just looking at those types of investments and those types of vehicles, and that's at 38 basis points. So we're comparing you as best we can to similar investments overall. And any questions on performance? Obviously, would love to come to you with a positive number, but all things considered, better than 87% of them out there. A little update, thank you, right there. So you can see this is as of April 29th. So it takes into account the swoon of April. Looks like the total market value was about $23,320,062. So probably about another 5% down during the month. US equities, Russell 3000 was down about 9% during the month, and fixed income was down as well. What does that do to the benefit index? Next page. As you may recall, obviously taking the equities out certainly has helped the volatility of this calculation. But even with fixed income selling off, you look in the bottom there, the cushion is still over 2 million. So that's been nice. That's where we stand right now, doing nothing and just sitting today. Additional things here on out are talking about possibly changing up some of the fixed incomes. I don't know if you want to pause and reflect or move on or take
Does
your
anybody have any
direction.
questions? Just anything before we get to fixed income.
Mhm. Yeah. They're the vehicles that we are able to access as this fund. There aren't many, and this particular fund is higher, but I'm glad that you're mentioning that. It's just, yeah, aren't too many options out there, but longer term, private equity is becoming more accessible, so I will expect these eventually come down. No, at least not that we know of or access, but I know it's been in the works for a lot of different providers. Eventually 401ks possibly will. So I have a couple things that we put in the back of the book. There's one which just simply has a little colorful blue chart. Want to kind of set the tone for what we're talking about. So currently, let's see what the percent weighting is. We currently have 4% allocated to principal high yield. It was one of the late additions.
It's in the back.
Yeah,
They're loose in the back.
yeah, it was a loose. It should be.
It was, you
Denise-
sent it to us.
Denise sent with the late additions. Okay, she sent the late edition version.
You sent it to us a few days ago. Yeah,
Okay.
that's what was in here.
Okay. Try to talk to it. So 4%, it's in. Okay.
So as she's looking, so is the objective to replace the high yield fund? Or is the objective to bring in a new strategy along with the high yield fund?
So many clients have both. We've always had strictly high yield.
Mhm.
And obviously that's been a lot tied into working with principal. So I would think longer term having both. Right now, I'll show you returns. Looks like, bank loans look great in this environment compared to high
Sure.
yield. But I think from a diversified fixed income program, maybe cutting the high yield in half, putting half into bank loans, half into high yield, calling it a day,
Mhm.
probably is the best move long
Okay.
term.
So it's more of diversifying out, the high yield than it is replacing the high yield fund.
Yes, but we have
The-
options that,
I understand, but the impetus is you want to diversify.
Yeah.
Okay.
Yeah.
Just clarify.
Yeah.
Yeah.
perfect, thank you. Share. Put it out back. Okay, thank you, yes. So this is trying to keep within the amount of time you'll have me before you throw me out of here, trying to keep this as simplistic as possible. So currently, we have high yield and high yield, and you think about the debt stack of a company, you have common equity. In the event there's a bankruptcy, your equity is probably worthless. Then you have bonds, which are generally unsecured. We're talking about high yield in this instance. Then there's a level that's above that that gets first priority on assets. Those are senior secured loans, and those are secured by those assets on the left-hand side of the page. So something as simple as cash, which they're probably not going to have much of if they're going through issues. But then you have equipment, intangibles, inventory, plant property, receivables, and any subsidiaries on there. So the goal is not to get to that point, but that's kind of the backdrop of that. And inherently, when you kind of look at historical returns and volatility, senior secured loans, there's certain time periods where it's not the case, but there's most time periods where on the whole, senior secured loans look less risky on the whole when packaged together. So right-hand side shows you some of just the high level differences. So the main difference as an investor alone is the nature of the relationship with interest rates. And senior secured loans have a floating mechanism. So when interest rates go up, there's mechanisms that reset these loans at higher rates to us as the lenders. So we benefit in that scenario. High yield, those are fixed loans. So you loan someone money for 5%. 5% is the rate until the loan is extinguished. The maturity date is also different. Generally shorter. These are shorter time period loans, 3 to 5 years versus 5 to 10. I'm speaking in general. There's obviously always exceptions. Security, I talked about that. You have liens on operating assets, and then where they are in the structure said senior secured loans. Senior is in the name, so they are generally more senior than your high yield bonds. They're generally more covenant tests, so making sure that the company has the appropriate assets and financial metrics to support these loans. There's just more, generally speaking, on these senior secured loans. Based on all that, historically, there is higher recovery rates for senior secured loans. Recent time period, past 10 years, most of the defaults we've been seeing are less than 3%. Obviously, if this situation we're in snowballs into something much larger, that number will go up, of course, but that would then hit us on all of our fixed income likely and our equities. Liquidity, generally speaking, senior secured loans are less liquid, but we are focusing on mutual fund investment vehicles, so that really won't impact us there too much. And then effective duration is going to be shorter for your senior secured loans. So if you are worried about interest rate exposure, one, you have the floating rate piece to it, and two, just shorter overall bonds. Jump back to the main book. Well, we'll jump back to that at the end, just kind of showing you where things were as of the end of April. You go to the first page of Exhibit 2. It's a big wall of text that says principal high yield replacement search. So these are just quick summaries of the managers that we have in this search. It is a mix of bank loans. There's one of these funds is a mix manager that does both. First one is Credit Suisse. They are a bank loan manager. They also will get some European exposure, which from time to time might not work out so well. But overall, we've had plenty of clients with them. They run basically the main bank loan index is kind of run by them. Invesco, this used to be called Oppenheimer. This particular strategy is a little more retail than others. It has a very low minimum, $1,000 minimum. It's great for people to be able to access it, but that can make it more prone to people jumping in and out, and that's not necessarily what we want. Also, historically, they've recently had really good performance in this environment. They tend to be a little more heavier weighted towards the energy sector than others, and past 10 years that hasn't really helped, but that can obviously increase some of the volatility. So you get kind of a volatility boost from being more retail and a volatility boost of kind of being more on energy. So while you will see the best performance of them this year, try to steer away from them if you have enough assets to pay for something with a higher minimum, which we do. And then Nuveen, this is the one kind of combo fund. They have been more allocated to high yield. So as I'll give you your update on their performance this year, they've been wrong, I guess, of where to put more of their assets. They can hold up to 100% high yield, 30% bank loans, and then they also allow themselves a little sleeve of convertible bonds overall. The lead PM, are also involved with their long short credit hedge fund. So they are very, it's very well pedigreed overall, but this fund recently has not done that great. Pacific, so this is from the Pacific Insurance Company. This is a bank loan strategy as well, pretty conservative overall, but we have a lot of clients now in this fund and been happy with this fund. It's not going to shoot the lights out necessarily, but also they tend to cut off deals and get out of investments before others, so that could be helpful on the downside. Siegel Bryant, this is strictly a high yield search for this particular investment. We kind of list there the various overweights they can do at various times. They kind of a more medium-sized team overall. Compared to some of the others against Nuveen, Pacific, Invesco, they are going to be smaller on the whole as a team. And then Shankman, they're kind of more mid to lower quality bias. This is their aim is to buy B type credit, which is sometimes triple C that they believe that they are finding deals. So they certainly have a credit desk mindset overall. So these next few pages here, these are the managers. This is what we presented last time. So it is through the end of the year. So that's why I did add in that update overall. If you turn a couple pages to page 3,
Which page?
let's go to page 3. It shows year to date, 1 year, 3 year, 5 year, 10 years, and 15 years. So overall on here, you can see each one of these managers will have their own little color scheme and shape on here. Long term, you see high yield has outperformed. Obviously, we've been in a overall decreasing interest rate environment, so you would expect in the long run that high yield would do a little better. Obviously, volatility will still likely be higher there, but overall, you can see all these managers been kind of top quartile in their space for the most part. There's always going to be exceptions within there. The one I would probably focus our attention on, would be Pacific overall. You do see they did underperform during the calendar year 2021, which, like I said, they are more conservative. Oppenheimer did fantastic when Invesco did fantastic when energy took off, and Credit Suisse has kind of been right in the middle for most time periods, but their rankings have been really good. On the high yield front, kind of looking at the bottom 2, Harbor, which is Shankman, has done better in the long run, as well as the more short term as well. We have individual years on the next page, so you can kind of see some of the volatility that these funds have. Let's go. All the way, let's just talk about fees for a second. Actually, let's go to page 12. You can see drawdown. The one here, the dark blue, that is Invesco. So like, as I mentioned, that's going to be the one with the most retail money as well as higher energy allocation. So that one did get hit harder than others. So there's anything else that really stands out. Siegel Bryant did protect a lot there during this particular time period on the high yield side. And to get a feel for how they are allocated, at least at year end, page 13, you can see the various weights that they have, the average effective maturities, as well as the average coupon and average credit quality overall. Then fees on page 15. So focus on the numbers on the far right, because that takes into account all the usual mutual fund fees. So Credit Suisse is at 70 basis points, Invesco at 82, Nuveen 74, Pacific at 72, Siegel Bryant at 70, and then Shankman / Harbor, the lowest at 64. The last page is just shows you flows. The one that stands out once again is that Invesco. Due to all the retail money jumping out of there from various times. And then we're probably most interested in the last handout, which shows you at least to the end of April. And I've been a tale of two cities. Bank loans on one hand, high yield on the other. On the far right, that's the principal fund. You can see that's been 6.16. So compared to peers in the high yield space, has protected a little bit better than others. We have Harbor on the far right next to that, and then Siegel Bryant kind of down the most so far this year. So while the Siegel Bryant protected the most in 2020, so far this year they've been whacked the most. And then Nuveen Symphony, which we said that's a mix, but they have been a lot heavier high yield. You see that's down with the high yield returns there. The three that are obviously not down as much, you have Credit Suisse on the far left down 0.32. Oppenheimer, that's the Invesco, it's positive 0.72. And then Pacific at negative 0.16 on there. So definitely it's been an environment that benefited bank loans. Certainly there are time periods where one strategy is better off than the other, and it's been a bank loan environment. Not here to predict what the Fed will do, but it seems like at this point, still all signs point to them wanting to raise interest rates considerably more in the next 12 months. So our thoughts long ago, once we're able to pull more money out of principal, is diversify a little more into fixed income, and bank loans is something we do with clients to help diversify. So at the very least, we would say pull half of the principal high yield. You want to keep the other half in there, that's fine. They obviously protected in this environment. And then open for conversation on if you're interested in which bank loan manager they're in.
Anybody have questions? I have a comment, but I was gonna. So I think that, if you want to, you're recommending that we add the floating rate in there, but I think if you reduce high yield, you are making the portfolio obviously less risky, and having 2% of high yield in a $25 million portfolio really doesn't do much for you. Mm-hmm. My recommendation would be to, if you want to bring in high yield, reduce some of the apples to apples, the less volatile fixed income, mm-hmm. and not take it from something that over time is going to give you some return, because we're not looking at 3 months or 4 months or sure. even 6 months. Mm-hmm. Over a 10-year period, high yield potentially will outperform. It's going to give you some more volatility, but it's probably going to give you a better return over time. So sure. I don't have any problems bringing in the floating rate, but I think we should pull it from something else of the fixed income piece. And that's just my opinion. I'm one of a bunch here. So, sure. But that would be my recommendation.
So just so everybody knows, so we have 11% in core, 11% in core plus, mm-hmm. and then 4% high yield, and then 4% in the principal preferred.
Correct.
So 11, 11, 4, and 4.
And correct me if I'm wrong, but pulling it from one of those is not going to hurt with the index.
Yeah. So I did a scenario. If we go the end of exhibit 1, the last page, it's a benefit index. It's yellow is highlighted. It said if high yield is removed. I did a scenario with high yield removed. If you were to take it from core or core plus, be slightly different. But you can see the cushion was, if in the event you pull this out, 1.2. I also did a quick scenario. Like hit the account with, let's say, a 15, if you have high yield out and you hit the account with a 15% drop of all assets and real estate, as well as what's left of fixed income. So a pretty significant hit. The benefit index does drop to 271,000. That would be
You're talking about another 15%.
15% on everything. Yeah. So I was trying to
Right.
shock and awe.
But if you take this, I mean, you were recommending taking it out of high yield. If you take it out, any one of these fixed income is going to be the same thing. It's all out of principal.
Well, our principle,
Yeah.
the factor is a little different. 75 versus my core
Right.
plus is 95. So it'll be,
A little bit different.
it won't be significant.
But that would be my, and we can change I don't have any problems changing the principal high yield fund.
Yep.
If that's your recommendation to go to another high yield fund. But again, not to beat the dead horse, but I don't think we should reduce the high yield lower than 4%.
And for those of you worried about the guidelines, which probably everyone is, the main part of the guidelines, all it says is 30% fixed income. Right. The only part we would change is the addendum where you just change the manager's name and the benchmark, which I don't think needs to go through.
We're staying within the,
Just the addendum.
we're keeping the fixed income all at 30%. We're just,
I have to look the last.
I
time
don't
took
know.
it because we checked it. That's not good. So I don't worry about that.
I guess maybe if you go back to the time when we added the international small cap, that would be in addition to the addendum, if you had to go to council for that, that would be kind of similar to this. We weren't like,
It is, it's just a-
okay, so a blip on the
It would-
agenda.
it Probably would make more sense just to take that from, did not make that part. It's not part of the policy.
Do some don't. It's
It's very close to one, but
so do you have a recommendation as far as which high yield? And I mean, we can look at this and we can debate it, but
sure.
what's your, hopefully you've analyzed these and
Yeah.
can come back and say, this is what we think.
Well, first and foremost, on the floating rate,
Mhm.
Pacific kind of gives us the most comfort. Like we said, the Invesco, it's done great this year, but that's retail. And
Mhm.
there's pitfalls with that. Credit Suisse, you do have a little bit additional European exposure there that maybe we don't want. So that kind of leaves us back with Pacific, which Pacific has been a top quartile performer for quite some time. So we have utmost confidence in them and kind of what they do. On the high yield side,
Mhm.
obviously, most recently, you've seen Principal protect, and that's not necessarily been a terrible thing. You go back to, we're at page 3 in this last exhibit. So you kind of look at the long-term numbers on there. I personally, and Marquette in general, we like Schenkman, which is considered Harbor here. We
Mhm.
know them a little more on their kind of private credit side. But they certainly have done a good job with this. Looking at minimums. Minimums wouldn't be an issue if we split this overall. So in the event you wanted to make the switch from principal on the high yield side, we'd probably recommend Harbor, which is Schenkman.
Would you recommend leaving some, if we need the numbers, to leave some into principal high yield? If we need for,
Yeah,
For
if it gives comfort to,
it doesn't matter to me. I'm talking about for the number, for the cushion.
Yeah.
That was gonna be my comment, is that it seems like the cushion gets hit. So we're talking about like $400,000 or $500,000 here.
No, it's,
2%.
I think, well, it was 1.2.
I'm talking about, what, we're talking about 4% at stake here, right?
4%
Yeah.
would be towards that. So that's roughly
900,000.
900 roughly.
So you were saying that a 900,000 move out of high yield
Mhm.
would essentially move the cushion down by that same amount?
Would move the cushion. yeah, let's
No,
see.
I think yeah, it's at 75% knock.
It goes from 2.1 million down to 1.2 million.
Yeah, that's the number down here.
Yeah,
So
so it's
it's
like almost a
about the-
million.
it's
It's
almost
basically
exactly.
1-to-1.
Yeah, it's almost. one.
Yeah.
So my take would be why mess with the cushion if we're not huge proponents of another high yield fund other than principal at this point.
Yeah, the cushion, if it gives you more comfort at this point and we can review again,
Yeah, there's no-
reason we can't.
Gun to our head or
Yeah.
anything. Works for me.
When you say 15% event, predominantly all fixed income, so it'd be another huge like.
It would
Bond
not, we would not
prices.
be having a good time if
Right.
if that happened, yeah.
Yeah.
But I was just trying to be as extreme.
I understand. I appreciate that.
I called the first quarter like a fixed income black swan event, so
Yeah.
hopefully there wouldn't be another one. of those.
Since 1843.
Right.
So we're gonna keep principal high yield, is that?
That would be my,
Are we good?
suggestion. You're on- you were on.
Okay, so if you go back to that April 29th, I think it's the last, at the end of exhibit one, near that.
Mhm.
I'm just missing the dates here, but like we talked about 11, 4, 4, and 11, that's the target. But is our current mix not less than that? I mean, isn't it to the left of that? Or,
Yeah, the target is 30 and we're a little underweight.
okay,
Right now there, we're
So-
overweight real estate, which makes us underweight.
Yeah,
everything
right.
else 'cause everything's sold out.
okay. Yep, okay, so that matches this here,
Now, this was at the end of March, so it's
a month earlier,
Yeah.
okay. Gotcha, okay. All right, that's all. I just want to make sure I was looking at the right numbers. Thank you.
So would a thought then, based on input I've heard here, maybe knock 2 off core, 2 off core plus, put
Sure.
that 4.
Because I think you're doing apples to apples then.
Yeah.
Yeah,
Okay.
so we need a motion.
So it would be 9,99444.
And I'm comfortable with that. Are you, is everybody?
Yeah, so,
Yes.
right. Yep, I'm fine with that.
Okay. So the motion is to add floating rate, 4% floating rate, and reduce core fixed income and core plus by 2% each.
Can you add in the motion where we're gonna,
And we're gonna
So-
use, and the fund we're gonna use is,
Specific, if that's. your choice.
Specific.
Yeah.
okay,
well, that's your recommendation,
It
so
is. Okay.
you've analyzed this, but more than we have, so.
I'll
Yes.
second it.
Is there any
Yeah.
discussion, any other discussion? Anybody on line have any discussion, questions?
No,
All in favor?
I,
Any
Aye.
opposed? All right, I think we're good.
That's
Is
that
that-
part of it. So the hope is that we could use our current provider for custody for that. We want to have that conversation.
well, yeah, we had it, we started that our last meeting where the current provider is subpar, I think,
Yep.
would be. And that is BMO or LPL or,
LPL, yep.
yeah.
That's who holds.
That's where,
Currently,
that's
yeah.
that's
currently.
right, okay.
I don't even know what they wouldn't even be able to do Pacific, right? Isn't that?
I have no idea.
okay.
What's
we-
the recommendation to change to?
So we did a price check, a blind price check to a few
Mhm.
different providers who went to Regions, who went to BMO, and then we went to Commerce Bank.
Mhm.
Commerce came in at 11.5 basis points. So that'd be about $16,000. No mention of a minimum fee that they had. BMO came in at 10, which would be about 14,000 change. But BMO said they normally have a minimum fee, but they waive it because they know us. Then Regions came in at 5, subject to a $10,000 minimum, annual minimum. The fee based on 5 basis points would be probably closer to 7 or 8 or 9,000. So we might get kind of bumped into the minimum fee there. But obviously comparing those three, the regions is obviously the.
Have you used them before?
Yeah, actually, City of Ladue uses them. They switched over to them a few years ago from Commerce.
Mhm.
And they're very happy. They run their benefit payments and everything. So this would be super simple for them. Their team is in Clayton. So they were very happy.
Works for me.
Yeah.
That's what, again, if you've had experience and you recommend them and it's going to give Darren trouble, that's all we care about.
Yeah. We'll keep you busy for a month or two. But yeah, extremely responsive. So your experience now will be,
Right. They're not very responsive,
Yeah.
but they're cheap.
they are cheap, free, right? I believe.
I think it's free basically.
It's
isn't
free.
it? Or
They were running,
Darren?
they were running like paper train
Yeah.
tickets, right? And you were maybe.
There was the
There was a time
modem
you thought they
sound.
lost
There
like
was,
$9
yeah,
million.
there was that, yeah. there
Not that I want to
was-
spend your money, but for $10,000 a year, it's on a $25 million portfolio, it's probably worth it.
We got,
Yes.
Yeah. it's been pretty hard.
Yeah.
It's been pretty hard to get everything and it's a little nerve wracking.
Yeah. So I think we should.
I don't have
Not only-
2 million to pay you back.
Yeah, it's not only just the reporting and your interactions with them, but when we do transfers in and out, I mean, you'll be fine.
So do we, I know that we can't make that decision, I assume, but we can have a motion.
Mhm.
And does it
Motion.
just get recommended then to council?
Well, I guess so, because it would be a regular. Yeah, I don't think the last time that we moved, did we? Oh, that was the choice of by us, though. We didn't end up with LPL just by a choice. It was because it got
Yeah, it
moved.
was given to you.
Yeah. Yeah. I don't know where we,
Gotcha.
We don't have anything, even though they're free, like we don't have anything like a cancellation fee or anything.
No, you just transfer.
Okay.
There might be a
Yeah.
ACAT fee or I don't know.
Right.
from that, but
There's gonna be a
$100
few,
bucks,
yeah.
$200.
Yeah.
Okay.
It's de
we might
minimis.
want to transfer it slowly, just because.
No, you want to get.
Rip off the
all out.
Band-Aid.
Yeah.
You just want to, you just
Get it
want to go. You just want to go.
I would request a motion to switch from LPL to regions. It's fine, yeah.
Perfect. Is there a second?
Oh.
Go ahead.
Motion.
Oh, go ahead and make the motion.
I'll make the motion to move from LPL, the Vanguard side of the portfolio from LPL to Regions Bank.
And I second.
Perfect. Any discussion? Fine, no. All right, all in favor?
Right.
Hi.
Any opposed? Excellent. We
Can I
made
ask one
Darren's day.
last- Can I ask one last question specific? That mutual fund, are there any trading restrictions or redemptions or anything like that?
No,
Is it,
good
it's
question.
liquid?
It is liquid. The minimum, I think the minimum is 500,000, but we get that waived. So there's not going to be as much churning at that 500K minimum.
Got it. Thank you.
Perfect. All right. Excellent. Thank
Okay.
you.
Very good. We did some
Appreciate it.
business.
Yes, thank
So
you.
should we should wait then until I hear on if there needs to be any regions discussions with council or anything, or just wait, I'll wait to hear from you. Okay. Okay.
It wouldn't hurt.
Okay.
They meet in 2 weeks and we can start,
Bless you.
nothing's gonna it's not gonna happen that quickly anyway.
No.
So we can start the process and then let them know. And- I mean, Greg, are you okay with that? I should ask Greg. It's actually, sorry.
Yeah, I'm fine with that.
Okay, so now y'all, that's on tape now, so.
As I will say the phrase that is so often said, but I only one vote.
Thank you.
Excellent. Appreciate your time.
Okay.
Thanks for coming.
Thanks.
I don't think there's anything else we need to,
No, if Greg
Do-
has an update on council.
Oh, my gosh.
oh, before you do that, wait, let's close the meeting and then he can give us an update.
You want-
Then,
Sure. If people want to leave.
yeah, 'cause
Oh,
I might
okay.
have to go shortly.
Okay,
I'm-
so
I
do
move-
it, do
I
it
move.
fast, Greg. You can-
Well,
Move to
I
close.
was having
All-
some trouble getting on the
Right.
meeting.
All right,
This
we're
was
closed.
my own fault, not anybody there. And so I didn't get as much chance to prepare coming in. Barb, help me. What's going on? I'm so-
Community center and the parks projects are really rocking and rolling.
That is
Stacy
true.
Park, if you drive by that, it looks really nice. We cut off one end of the pavilion that was the overhang, and we've totally gutted that inside the bathrooms and the storage area. They put on a new roof, and then the new pavilion is actually the foundation and the pilasters are up. And that will get delivered hopefully in August. We had to order that about a year in advance, almost 9 months and 10 months in advance. And so that's going forward. They're working on the foundation still at the community center. They're going to be moving into Villa Park. They were hoping to do it this week with some of the taking down the trees, some of the trees that need to come down. So that's happening. The Firestone has a temporary occupancy permit now. The Oliver is looking to open probably they were hoping in May, but they have had a supply chain issue with one piece for their electrical system. And so they should be opening in June. That's kind of Plant Haven is hoping to be done. They were looking for June, but they have a family wedding, and so that's not gonna probably be until July. They're trying to really finish the end that is gonna be the actual nursery, so that they can open that and be ready for like August for the fall season.
Do they have tenants yet for that?
They have not announced any yet, but I know they have 3 that they're in final discussions with. So they're hoping to go in with everything, some other services, yeah. Berg, I don't know off the top of my head. I'm sorry.
It's always, Barb always knows more than we do anyway.
We have a lot of stormwater work we need to do there. And we have a lot of water issues there too. And so we have to put in some stormwater work. We have to do we're taking up all of we're going to take up most of the asphalt. We're going to put in a new parking lot. We're expanding the parking lot a little bit. And then they're also doing a lot of some additional trails, walking paths in there. And so they probably would have had it torn up a week ago. Weather hasn't, it's been so rainy, and the base, we have to do something so that we don't go down too far. We don't mill too far down to do any kind of overlay, because the base is pretty wet. And if we end up hitting the base, we'll probably end up having to go down another 1 to 2 feet to add extra base. It's a swamp. You got alligators under there.
Well, let's open a zoo.
School? Oh, yeah. We started conversations with the school in January, and February, because we had just gotten a contractor, and we said at some point, we'll need to close that. And then when we got the contractor and we got some dates. And so I was emailing with the superintendent in March. And then I started emailing the superintendent and the Old Bonham principal. And then we were getting about 2 weeks out, and they were really getting ready to leave for spring break. And they called and they said, "Well, are you closing it?" So we've been pushing, the weather has helped a little bit, pushing it back and pushing it further out. So I think we got it to where I think, they have 3 weeks left. The issue was, if we delayed it, we were going to move up another park. It wasn't, we could just delay it to, we'll just delay this project for a few weeks. It was, we were going to end up having it closed in the fall when the school opened, and they still weren't going to have, and their project still wasn't going to be done then. So it was either do it, we decided we just rip the Band-Aid off. That at this point, we should have some good weather for people walking.
So it sounds like the superintendent.
I don't know how they communicate. They've got a lot of folks over there and so, yeah. So we did talk. I think it was kind of always this hope of maybe it won't happen. And with all the rain, it took a while. So they moved it to this week. And actually, we probably could have held off a couple of days from this week. Unfortunately. We do really try to work together and talk about things, but
Thank you.
all right, thanks. Thanks, guys.
All right, thank you, everyone. Have a great evening.